Well, hey, when you go out to buy a vehicle, in this case a nice ute, you've got a couple of options. You could buy one brand new, or you could buy something that's used, that's a few years old. So let's have a look at some of the differences in the prices and try and explain what's going on. If I was to go out today, 2021, and buy a brand new Isuzu D-Max SHH Ride, High Ride, whatever, fancy name, but it'd cost me about this. The new price for this vehicle is $44,000 almost. Okay, but if I went and looked on, say, carsales.com, I could probably find, well, here's one here that we did find. It's what, 4 years old. It's the same vehicle, although it's got the cab, it's got the doors at the back there, but look, close enough. Is that going to be the same price or similar? Well, no, in fact, it's quite a bit different. It's $30,000, which is a difference of $14,000. Well, in 4 years, where did the $14,000 go? Why has the value changed so much? Well, it's this thing that we call depreciation. Okay, so over time, most things will reduce in value, and that's what depreciation is. It's a reduction in the value of an asset over time. So an asset is something you have, something you own, and over time, most assets will decrease in value. Not always. We've looked at a previous video about things that might go up in terms of appreciation, like maybe if this was a rare item or something like that. So as far as maths goes, when we're doing these, there's two different types of depreciation that we're going to need to calculate. In this video, we're just going to look at the first one, which is the easiest one, and we call that straight line depreciation. We call it straight line because if you were to graph the value, it goes down in a straight line because we're just taking the same amount of dollars off every year. The second one, which is a little trickier, which we'll look at in the next video, is called declining balance method of depreciation. Okay, and that's where instead of taking a constant dollar amount, we take a constant percentage off the current value each time. Now, depreciation is pretty important, especially if you're going to go into your own business. For example, taxation is you can claim on some items the depreciation as a cost to your business. So if you're going to be involved in business or buying things for your work, say if you're a teacher and you go out and buy yourself a new laptop, you can, as part of your tax, you can actually depreciate some of that cost over time. So it's something that you will have to, so you will probably come across at some point in your real life. Hey, let's have a look at this straight line depreciation and see how it works. We've got, let's say for example, you had a car that was worth you buy it for $20,000 and it depreciated by $2,000 each year. Well, after the first year, it'd be worth $18,000, wouldn't it? Then after the second year, $16,000. So we're just going to take $2,000 off every time, and that's it. That's as hard as straight line depreciation gets. But we do have a fancy little formula. It might look a little bit fancy, but when we do the example in a minute, you'll see basically what's going on here is just common sense. But let's quickly go through the words and the terms in the equation. It's S equals VO minus DN. S is the salvage value. By salvage value, we mean what is it worth right now. If you would go and sell it right now, it's the current value, okay, the present value, I guess, of the vehicle. VO is what it cost at the start, okay, when you originally bought it, the initial value of the vehicle. D is just what is the depreciation amount, how much is it depreciating every year, and N is the number of time periods, so over how many years or how many time periods. So let's have a look at an example. Molly pays $14,500 for a used car, and we're going to say in this case it depreciates $1,100 every year. After 3 years, how much is Molly's car worth? Well, it's pretty straightforward. You could probably do that in your head, but let's go through and use the formula. Let's identify each of the things. The VO, the initial value, is what she paid for it, the $14,500. The D is the amount of depreciation. In this case, it's the $1,100. And N is the number of time periods. We're looking at 3 years depreciation. I can just take those values now, put them all into our formula for straight line depreciation, and I'll get this calculation. Now, here's where, just like I said, you could have done this, I guess, with common sense. If you think, well, it's that much to start with, and I take away that much depreciation, times 3 years, because it's that much per year for 3 years. I take that away from the original amount. That's all that's going on. And after 3 years, her car has depreciated and is now worth $11,200. That is straight line depreciation. Good job. Well done.